The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. I'm going to start the show today going over some long-term charts just to show you some of these patterns from a very long-term perspective. The first one I put in, of course, was the market from 1929 through 1932. The reason for that is tomorrow is the anniversary date of the low in the stock market in 1932. Excuse me, that was 1932. The Dow hit 42. On September the 3rd, as you can see on this chart here, it was making a three-drive to a top pattern at the 383 level. That's not the worst crash ever, folks. The Nasdaq gave back 85% of its money back in 2000. It went from, I believe, 5,000 to, as I recall, I think that was correct. I might be wrong on this, but I have to double-check it. Anyway, the important thing are the patterns that are there. You know, these are the things. They don't really change very much over the years. The news changes a little bit here and there, but that's the primary thing that we're looking at today. Now, there's some other things that I wanted to show you today, just to some of the research that I do, and that is when we were looking at these time frames, I wanted to show you what was happening in the sky during the time of July the 5th through the 8th of 1932. As you can see, all of these cycles were lined up in one particular quadrant of the stock market, and that tells us that these cycles, you don't have to know a lot about astrology, just tells you that these cycles, which are all days, were coming together pretty much near the same time. So it was a very, very important time period. If you'll remember, back in March of 2009, I was very bullish at that time. For all the patterns completing, we had a three-drive pattern on the, on the S&P, the Nasdaq. Everything was just lining up. We were at a 61% retracement from the 1987 low when the Dow hit 64.60 that day. And as you can see here, we had a lot of planets that were lined up on March 5th, and that was the high day. If we take a look at the high from 1932, if you'll give me 1 second here, excuse me, high from 1929, hopefully I can find it. Oh boy, maybe I can't find it. I guess I can't. Well, I'll have to pass on that one. I know I put it in, I don't know where it is, but we'll have to worry about that just a little bit later. I will find it. I know I've got it here somewhere. It's just a matter of catching it. Doggone it. That's what happens when you're Italian. I found it. Yay. You can just walk and chew gum at the same time. You're okay. And here again, as you can see, that on the top on September 3rd, 1929, that there were all the things were lined up on the one half of the quadrant, which was very important to have cycles. Now, those of you that remember J.P. Morgan, he had a full-time astrologer named Evangeline Adams, and she worked for him as a financial astrologer for many years. And she was, quite adept at looking at things. She never published any of her things. Her library was bought by a private investor many years ago, and never shared any of the material that was in the particular things that she had. In the Morgan Library, there right off of Rockefeller Center, where J.P. Morgan lived, there's very little to do with astrology other than the big library, which was his private office. The ceiling is a celestial, a copy of what's happening in the sky. And he was born on April 17th, and under his sign on the zodiac is where the secret entrance was, where he walked in from his bedroom downstairs. He took the little elevator down into the library, and it opened right at April 17th. So it was very interesting. If you ever go there, it's really a spectacular place to see. He had the most incredible collections of Bibles in the world. They still are the best. even better than the Smithsonian. So it's really interesting to go through this. But anyway, these cycles are coming together, pretty nicely. The patterns are lining up, pretty much the way that we were looking at it. And I just wanted to just show some of the shorter term ones so that we can get an idea of, where we might be here in the market. We'll start out with the Nasdaq because it has been the most bullish, and as you can see, as of Thursdays, we had gone up and made a 1.618 expansion of the move from February down through April. That was very similar to the move we had from January to February, and now we have the same thing February to April. So if that's the case, it tells us that stocks probably topped on Thursday and will probably not go in very much higher. Remember, last week was an incredibly bullish statistical week because we started the week on the last day of the month, which in an up month and an up week is about a 70% chance that the market will close higher. The first 3 days of the month, first 3 trading days of the month are the most powerful. That was Tuesday, Wednesday, and Thursday, and the market was up all 3 of those days. And also the day before a holiday was, July the 4th, so July 3rd was the day before the holiday. We had a very big move in the market, the Dow up over 100, and the Nasdaq was up, I think Nasdaq was up over 100 points for the week. And so that's where they closed at that particular time. But the day before a holiday, as you know, is better than 75% of the time being profitable. And the July 3rd date is the second most popular date of the holidays. The first one is the day before Thanksgiving. I believe that one is 80% chance of the market closing higher on the day before Thanksgiving. That's in bull markets and bear markets, but that's what usually happens on holidays. So with that, all that positive stuff out of the way, we come in this week, and we have a whole new set of rules because we're in a normal we're in the regular trading week now with nothing statistically, positive happening. The next chart that I wanted to post with you was from JP Morgan Asset Management that shows this expanding triangle that we've been looking at for quite some time. This happens to be the S&P 500, and it shows the earnings and where we are in relation to other time frames and what the earnings places, what the earnings expectations and actual earnings were at that time. I only bring this to your attention because they're numbers. I don't really care about earnings because I'm not a fundamentalist. I do everything technical, but when it has to relate it to numbers, I would like to see it. So that's why I'm bringing it to your attention that they're looking at this. They're not saying that this is the top of the market. They're just saying here, just be a little bit cautious. Well, I think you should be a little bit more than a little bit cautious, but we'll have to wait and see if that in fact is going to be the case. Now, I wanted to show the Dow Jones Weekly here because this has a very interesting symmetrical pattern from August to January. We went up into a new high. Right on New Year's Eve, as you recall, and then we came down into that January effect that ended right on February the 4th. But from the December high to the April high was 13 weeks, and from the April high to where we were Friday was 13 weeks. So we have that Fibonacci sequence of 13 weeks also coming in at the same time as these patterns were completing. And as you can see, that pattern in the S&P was a beautiful, the Dow Jones was a beautiful 3-drive to a top pattern. One other comment I wanted to make is about the Dow at 17,000, folks. I said before that I don't think it means absolutely anything, and the reason for that is the Dow Jones people that run the Dow Jones, which is part of McGraw-Hill, they change the index whenever they want to, because if they find a stock that is not performing well, like last September they exchanged Bank of America, Alcoa, and Hewlett-Packard, and they exchanged them with very high-priced stocks like Goldman Sachs and Nike and Visa. And because the Dow Jones is a price-weighted index, the higher the price weight of the stock makes the index go higher. And so it's not a cap-weighted index where you take all the shares and whatever the price of those shares are to find out what the value of the company is. That's not the way the Dow is done. It's not a very good index for really telling you what the market is doing. The New York Stock Exchange Index is by far better than that, but it's the Dow Jones that's got all the press. and that's why we watch it all the time. They've trained us like little monkeys, to go to the stream and wash our coconuts before we eat them, and so that's what we do. But the Dow is not a very good indicator of what the market is actually, really doing. It certainly really isn't. I want to share this the Nasdaq daily here with you that goes back a little over just about a year, and it shows that we are in the 55th week of 55 days up. The first move was 21 days up. This move was 55 days up, and so we're coming into a lot of Fibonacci stuff this week. But frankly, the patterns are what are really moving these markets, in my opinion, and that's what is the most important factor, to look at. If you have any questions, it's 877-927-6648. Okay, the next one we're going to take a look at is the New York Stock Exchange Index on the monthly basis, and we will take a look at this. As you can see, we've completed that 1, 2, 3, 4, 5 expanding triangle. We've completed the ABCD pattern that was there. So we're in the zone here where we should be looking for the minimum of a correction. And I know a correction in the stock market these days would be a day where it goes down more than 2 days, because we haven't had more than a 2-day correction in the S&P, I don't think, since April. It's been a one heck of a run here, and this is not how bull markets begin, folks. These are how bull markets end. Keep that in mind. They extend themselves to the upside just like they extended themselves to the downside when prices were going to the making new lows back in March of 2009. What we've got set up now is a situation that should be dramatically worse than what happened in 2008. 2008 should have been the shaking of the tree, the rattling of the sword, but waking everybody up. But the really bad one should happen now. The reasoning behind that we'll go to after the break, of course, but there's several things that are telling us that we're very, very close to this occurring. Frankly, I think we topped on Thursday, but I'm still not sure. I think we need to get the Dow below 16,800, and then I would say, yes, that probably is going to be the top for a considerable length of time, if not in my lifetime, but we'll have to let history decide if this is going to be the case or not. Frankly, folks, when I was doing this preparation, I had not seen, I looked at things that I just could not believe were trading where they were. It's just been an amazing run here to see the market go up and not participate in it, which I haven't participated in the short side very much either, except for Thursday I started to do a little bit. Okay, we'll take a little break here. We'll come back. We're going to talk a little bit more about some stocks.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I wanted to expand a little bit on this expanding triangle pattern that we have working in all of the indices on the monthlies and weeklies and dailies. It's the 1, 2, 3, 4, 5 reverse point wave, or T6 pattern in Gartley's book. The reason why I posted the soybean chart in here is to show you what's probably going to happen to the stock market, because these are just numbers. Nothing's any different. I know soybeans haven't much to do with stocks, but the patterns do. And this is what usually happens after you have a reverse point wave like this that we have in the soybeans. You see soybeans have dropped from $12.78 all the way down to $11.20. That's $7,500 a contract, which is a great deal of money involved. And today they gapped down below the 786 on good weather in the Midwest, which is good because we need huge crops just to stay even from where we were last year. And that's what's caused all this selling in the grains, is the fact that we have planted a lot more soybeans than we ever have, and also a lot more corn. But anyway, the pattern says that this is what should happen to the stock market since this pattern is hit. Now, we'll have an original sell-off here, whatever it happens to be. The key figure that I'm watching is at 19,800 in the Dow Jones, and in the September S&P futures, the E-mini contract, I'm looking at 1943. We're about 27 points away from that, so it's still quite a ways to go. But once it triggers that, to me, it would tell us that we're going below last week's lows. And after making all of those number expansions like we did at 1.618 or 1.27, it's really going to be interesting to see what happens, at that particular time in the market, if in fact that is what we're going to be looking at. I also posted the chart of the IWM, which is the Russell Small Cap, and as you can see, we made a slightly higher high last Wednesday, and the market it was a double top, and then the market has quickly reversed most of that, and it is the weakest element right now, working through the stock indices that we're looking at. We also have a very interesting pattern that deserves our attention, and that is the banking index, the BKK, because we went up to a 786 retracement on July the 3rd. That also completed the head and shoulders pattern that was there. So we have a head and shoulders pattern coming at the same time. Now, this puts the market with no margin of error, folks. That means if the stock market closes higher this week, all of this timing stuff that I'm looking at is incorrect. So it has to turn down this week. That's the bottom line of what we're looking at. The key figures, of course, are 19,800 in the Dow and 1943 in the S&P futures. So, but that's still a long way from where we are now. But if in fact this is going to be the high, we're not going to be higher this week than we were last week because of all the timing and all the number sequences that are there. If it breaks those numbers, that tells us that it wants to go to another level. Once it breaks 127, it'll go to 1.618. If it breaks 1.618, it could go to 2.618 or 3.14 or 4.2. It could go to anything. And you just got to be really careful in order to not get run over by a train. But if the stock market closes lower this week, that would tell us that we have a really strong indication here that we are at a point where the market should, turn down quite a bit. Now, the Dow Jones Transportation on Friday made a slightly higher high by just a couple of cents, trading at 82.88, and it also has completed patterns up here to the same extent that we've had in some of the others. Remember back in October of 2007 when the market started down, that was the high. The high was October 12th, I believe, of 2007. Bernanke was on that week, and he was talking about the subprime conflict problem, and he said he didn't see it too much of a problem for the economy, that it was just something that they would be able to work it out themselves, and you saw what happened. People don't remember that stuff, but if you go on the internet and pull up at what he was saying at that time, you'll see that that's what he was saying. And, Dr. Yellen is Yellen, too. I don't know why her name is Yellen, because that sure is really good for someone that's in the the banking business anyway. So that'll be interesting to see how this unfolds. Frankly, I think the Federal Reserve has pulled off one of the biggest Ponzi bubbles we've seen since Bernie Madoff played the game, but we'll have to wait and see. Still got the Dow down just a little bit, the S&P down a bit, the Nasdaq basically unchanged.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, Nasdaq, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, we're back, and I've had a question about the transit charts. These are where the planetary alignments are. These are the cycles that we watch, how they line up. And I put in for July 8th, which is tomorrow. That's the anniversary date of the low in the stock market from 1932. And as you can see, there's a great deal of things happening, but everything is lined up in basically 3 quadrants. Not just one side. So it's just got a lot of things happening. As you can see, there's a great deal of cycles that are occurring on that date. We can be a day off, or 2 days off, because these things move rather slowly, with the exception of the moon and Mercury. The rest of them move rather slowly, so they don't change, very, very quickly. So that's what we're basically looking at here. You don't have to make an interpretation of it. You just have to look to see where these cycles are and determine. The way I found how the market moved was I'd go back to look at all the lows, 1974, 1982. I looked at 87 high, the 87 low. All of those were, fit with these aspects that I were looking at. But the problem is they're never 100%. I thought April 22nd was going to be one of the biggest things ever, and nothing really happened. So it's only probabilities. We got a caller from Minnesota, and he has a question about silver and gold. Bill, are you there? Evidently not. He must have answered his question in silver and gold, so we'll have to wait and see. I really think that silver and gold are going higher. I would like to see a correction in gold down to at least 1,300 or possibly 1,280 per ounce, and silver get down below right at $20 an ounce. That would be an ideal situation to take a look at it. So that's what I would be watching. What I want to cover now is I want to cover some of these little oscillators that people look like that watch. Like there's one called the Fear Index, and this is brought out by the Sentiment Trader, and it makes it look. Oh, he's got on just a second. We'll have Bill on here. Bill, are you there? I'm not hearing Bill. I don't know why. It's not working. I don't know if Bill can hear me, but I can't hear Bill. I'm just going to keep working then and not worry about it. But as you can see, we've broken into new high ground here. There's absolutely no fear in the market at all. I mean, we're almost at zero. We had the same thing happening. One of the reasons why it looks so interesting in the market for coming in today on the short side is because we had a short-term cycle. It was a very short-term cycle, a little 14-day cycle that's been in there from low to low, and we made a new low in the VIX index on that Thursday, coming in pretty much as expected. That's why I said that I didn't think that we could be higher coming in today, that the top was either going to be made on the 3rd or the 8th. That's what I was thinking of. I spent a lot of time over the weekend looking at that, and I thought the best time to look at it would be either Sunday or Monday for the potential short. But if we go higher this week in stocks, there's something seriously wrong with my timing. And believe me, that's happened more than once. But boy, there's so much stuff out here. It's not a question of if, it's a question of when. And it's going to be very, very bad. That much I'm 100% sure of. The other one that I wanted to mention to you is to show you the similarities to what's happened with margin debt during these last long-term cycles that we've had going back to 1999. We had record margin debt then, and then record margin debt in 2007, and now we're at all-time high. We've even taken out the margin debt from 1929. And that in itself should mean something, but these patterns are certainly completing, and it should be a really fun summer and fall, given the fact that, those are the dull months, but they can be some of the most volatile, and the market has a tendency to make lows in October more than any other month. So that's very important also. Now, the next one I wanted to share with you is from our friends at the Federal Reserve, the St. Louis Federal Reserve. It publishes a stress index, and it shows that the stress index is now, making all-time lows. I guess it doesn't count the people that are unemployed. Do not, don't count in the stress index, but who knows? That's the other thing I mentioned about the Dow Jones, how they changed the stocks in the Dow Jones. They do the same thing with the employment figures, folks. What they do is they come in and they change it. If a person's unemployed for 18 months, whatever it is, they figure they're totally unemployable, and they drop them out of the labor force. They're not counted anymore. And that's why the rate can go from 8% to 6.1 is because the people dropping out are no longer counted. It doesn't make sense, but that's in fact what's happened. So remember that these figures are there. You know what they say, figures don't lie, but liars do figure. I remember that from my old high school days, but we'll see. Now we're going to take a look at the bull and bear index. This one is really interesting because we have just popped up with another big move up to the upside, and that's another one that is way oversold, or overbought from that perspective. Now I wanted to talk about the semiconductor index, because we're also making a long-term butterfly pattern on the weekly SOX index, which is the semiconductors, I believe, and we completed that coming in Friday. So that was right at the 1.27 level. That's why all these things are really coming together rather nicely. As far as timing coming together is what makes it so very, very interesting. The utility index, which has been pretty strong recently, had turned down earlier. It turned down last week, and with the rest of the market up, the utility index was moving to the downside. I hadn't checked it yet today. Don't trade it. I just watch it because of the Dow theory, and that's what I'm really watching it for. Sometimes it will give us an indication that the market will be able to see it. And I wanted to also do the Dow Jones Transportation Index here because it also made a slightly higher high here on Thursday by just a few cents, and I haven't checked it yet today or not, but we'll see what it's going to be doing. We got the Dow was down very little. Was it down about? Just can't even see it anymore. Huh. Hold on a second. Let's see if I got my data stream messed up here. Okay, we got the Dow. Well, Dow's down 100 points. That's quite a bit. That's all of the gains of almost Friday, so we'll see what happens. But I really believe that this is something big happened over the holiday, folks. Whether it's going to be the thing that counts very much or not, I don't know. But, boy, all these things are sure lining up number-wise that make us wonder that it's going to be something just really, really gangbusters. I know it's going to be worse than 2008. I'm getting ready for that already. So we'll have to wait and see. The big index that really is the whole market to me is the New York Stock Exchange Index. You'll see that on the daily chart we completed a big ABCD, perfect ABCD with price coming in at 11,104 on Thursday with a very light volume. And this light volume should be some concern. There's one other concern that happened on Thursday, but it was a very light volume day. But even with the market being up strong, the stock indices lost open interest. And when things go up and you're losing open interest, that's short covering, folks. That's not a good bullish indicator. So if we don't start getting open interest increases in the stock indices here, they're going to follow their own weight. And you know that prices go down faster than they go up. Isaac Newton's laws have never been repealed. What goes up must come down eventually, with the exception of Hong Kong real estate and London real estate, and pretty soon New York real estate. But that's pretty much what it is. But Newton's third law of motion, for every action, there's an equal but opposite reaction. It works all the time, and that's where we get these Fibonacci numbers from, and the ABCD patterns, and the Gartleys, and the butterflies, and all of the other things that were there. What we're, last week on the 26th and the 23rd of June, we had the P-index dates, and nothing really happened, during that time. So, my assumption is we're coming down into the full moon. The full moon is going to be on the 12th. We'll probably be down this week. Starting on a down week, it usually will start bringing in some selling. How much selling will give us an idea of what's going to happen. If the Dow gives up everything that it made last week, the 288 points, if it gets below 16,800, they got a problem over there in River City. And that's only we're down 100 some points today, about 100 points today, so it doesn't take much to get it below that 16,800 level. That'd be equivalent to 1943 in the S&P futures. 1943 would be the price in the S&P futures. That would be something that I think would be watching. Now, I'm going to be coming in here. If you think it's bad in the stock market, folks, this is not the problem. The stock market is not the problem. The problem is in the credit market. The credit market is where the problem lies. We're going to see another credit crunch. Credit has been basically totally free and available now since 2009. After the crash of 2008, they started opening the VATs. I think it was 2011. Bernanke came up with the idea of quantitative easing 1, 2, 3, 4, 5, 6, whatever we're on now. I don't know, but the real problem lies in credit. Folks, Spanish bonds, Spanish 30-year government bonds sell at a lower yield than U.S. Treasuries. And it wasn't until recently that the Spanish bonds were just barely above junk quality. That's very, very bad sign. We're also seeing the same thing in other countries like France. So they're able to borrow money cheaper than the United States, and with the dollar holding up relatively well, there's something that's not right here, folks. It's going to be really, really nasty when this thing finally does occur. We've had a request to take a look at the emerging market index. If you'll give me a second here, I will put this up and we'll take a look at it. In fact, it just completed that same pattern. It's gone up to the D point again. I still think that this market is ready to turn down. We'll have to wait and see if that's the case or not. But I want to get back to, the emerging market took out the highs of June by just a little bit, but they're probably getting ready to turn down again. They've got to get above 46, get another 5% higher for this thing to really collapse and fall out of bed. That's what I would think I would be looking at if I was in the EMM, which I'm not. I just happen to, take a look at it to see what's happened. The Dow Jones Transportation today, I was just informed, is down quite a bit from that pattern we were looking at. I'll post that in here and update it because I did this over the weekend, as I must, because I have to prepare for the coming week. And as you can see, it's down. Looks like it's down about 70 points in the transportation, so it's no big deal. The Dow being down 80 is nothing. But the real problem is not in the stocks. I mean, it's going to be bad in stocks, and that's the one that they talk about. But the real problem is in the credit market. Credit has been very, very available now for 5 years, maybe longer. And now what we're going to see is a credit crunch. In other words, credit's not going to be made available, and that means that these things are going to be pushed to the brink, and that's going to really cause a really, really big problem. I'm going to post the chart for the we got a call from Scott. Are you there, Scott?
I am, Larry. Can you hear me?
I certainly can, and I recognize your voice. How are you?
Oh, you're my buddy. You know that. Okay, I got a question. I hope it's not off the. It is a little bit off of what you're discussing. I would like to hear you follow through with the credit stuff. But I have a question on open interest. It's always confused me. And last week, I think you said sometime that you could tell that the metals were running out of steam because the open interest was diminishing when silver and I'm not sure about gold were near their highs. And I know there's a very strong, or at least I'm reading that there's a very strong short position by the commercials on metals, by the brokers or whoever is on the other side of this. And so I'd assume that represents a certain amount of open interest. If it doesn't, then you can correct me. But if they get squeezed, you think the metals are going higher, and if they get squeezed, they get forced out of their short positions. Does that diminish the open interest? And if it does, how does the open interest formula work for markets that are breaking higher from a strong short position from the commercials? I mean, things change here. Do you know what I mean? Can you clarify that?
Sure, I'll try to do that. Let's just, for every buyer, there has to be a seller. That makes the open interest increase by 1. Okay? So if if the prices are going up and open interest is dropping, that means that someone is buying back their position at a higher price and leaving the market. That's the short leaving the market, not the long. It's the short leaving the market. He's buying back his position and getting out, thus open interest drops. In April of 2012, when we were making big highs in the silver up around 49, open interest was dropping dramatically. Scott, we've got to pay some bills here. Will you stay with me, please?
Will do.
Yes, please do.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back, folks, and we have Scott from Tampa on the line. And Scott, you were asking about open interest, and the problem with open interest in metals. And it's also a problem in the grain somewhat, but not so much. But the metals, there's a huge cash market that goes on in copper and silver and gold where people want physical delivery of these. And that you don't see that show up. That's where the physicals come in, and where you have firms that like J.P. Morgan, who's supposedly a huge short in the silver market. I don't know if that's true or not, but they're supposed to hedge those positions, and sometimes they're basically unhedged, and so they're basically physically short the silver. But you don't see that because it's not in the exchange, because all we see is what's exchange traded. We don't see the physicals that are traded off the books. Must have lost Scott. That's okay.
Yeah, I'm still here. Can you hear me?
Okay, but that, yeah, sure did. Thanks for holding on. But that's what the problem is that there's a huge physical market that is out there, that as there is in grains and other things too. So we have to remember that when we're looking at exchange traded things, the things that we put our contracts on, that's what we have to work with. But there's other things that are out there. That's why I've always said no matter what you're looking at, there's only one thing that matters when you're trading, and that's that bar chart that you're looking at. If prices are going up, there's more buyers. If prices are going down, there's more sellers. And the only thing you can control is the amount of risk that you have on a trade, and that's what you should, focus on. So I try to bring a lot of things into this that might make a meaning of something like the VIX and all these other things. But frankly, it's the price action that tells us whether this market wants to go higher or lower. Whether it's silver, gold, or stocks.
Well, Larry, if you were watching price action in, let's say, silver, just to make it simple, and you think that it's found a bottom, and then there's a rally from a week or two or so ago, and you have a feeling, whatever that means, that the market's going to go higher, do you look for some kind of a change in the open interest, or is there something other than the price action? Because, silver doesn't really, it looks like it could have resistance. It has.
It certainly does. It's hard to trade, too, because it's a lot less liquid than gold. It's about 1/6 the liquidity that gold, so that's why it's difficult. But I don't look at the open interest. I look at it every other day. I keep a record of what it does on the first of the week versus the end of the week. And then if it's down on the week, that certainly tells me something. But to watch it every day, it's not instrumental in me making money because I'm interested in, the patterns, and that's primarily what I'm looking at. But when I don't have a feeling for something, what I have is a pattern. I gave up trading off feelings many years ago. They didn't serve me very well, but the patterns serve me well because they allow me to quantify the amount of risk that I have on a trade. If I buy it at the 618, I stop it out below the 786. That's a quantifiable number that I can work with. My feelings, I don't have a number like that.
And so your decisions are not at all on open interest, really. It's just on the patterns and your numbers.
That's correct. My opinion will vary a little bit by open interest, but the patterns are the bottom line of what to look at because that's the sum total of all the buyers and sellers, and that's what I really have a handle on is if I look at that, I can tell that's where we are at that particular time.
And can we extend that to one more quick question?
Sure, please.
Since you are looking at earlier today at the astrological things, sometimes you look at the Brady, is that the same way you handle those? You're still looking at your patterns, and do you give those more priority than the astrological stuff that you were talking about earlier today?
Patterns are perfect for me because they tell you exactly where you are. The astrology stuff, I only have a handle probably on 60% of it, if that. So that's it. Thanks for calling in, Scott. We have to take a break. I appreciate it very much.
Talk to you later.
You bet. Live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.